to have your company on this 18th day of November. My name's Jessica Amir, market strategist with Moomoo. So if you've been waiting for a market crash to buy stocks that you like, well, we've got more ingredients to be added to the mix to support this level of thinking. We saw the NASDAQ 100 4.8% overnight, but the small cap index was indefinitely hit the hardest. The Russell 2000 shed about 2%, but you have to pay attention when you've got all three of the key indices, including the S&P 500 closing at the lows of the day. This basically suggests that there's more selling to come and the bears are in control of the market, pushing stocks lower. Similar themes playing out in cryptocurrency markets. Bitcoin is down to $91,800 US. Obviously, that's down almost 30% from its highs. More dark days probably ahead, and that's because we've got institutional selling. So don't expect a recovery until buying returns from instos. So all in all, just quickly, why are worries intensifying that something bad could be brewing in financial markets? Well, you do have to remember that we've got the NASDAQ 100 already down 5.3%. But why are bets out there that markets could puke before they rebound? Well, just quickly, it's four quick reasons. Trend lines appear to be pointing downwards according to our technical analysis. Secondly, worrying is intensifying about tech and small companies engaging in dodgy borrowing. Moody's, a rating agency, basically called this out overnight, saying, hey, there's obscure leverage. That's kind of simmering beneath market's surface. The other thing that is worrying investors is what happens if we get bad economic news out of the US this week. That basically means that the US won't support interest rate cuts. That's what some are thinking. And fourthly, Nvidia's earnings are out on Wednesday. Will they show that their revenue and profits are continuing to slow? Maybe more than expected. This is a worry. Options markets are suggesting that Nvidia could swing 6.5%, maybe lower if investors don't like what they hear. Also consider that a hedge fund manager, Peter Thiel, also revealed that his stake in the company in Nvidia has completely been closed. So he no longer is holding any Nvidia shares. But I always say there's always a bull market somewhere, and lithium seems to be in a supersonic lithium boom. And I think you should be watching lithium. I've been talking about lithium for many years now, but here is precisely why you need to watch it. So the lithium price is moving on up. The lithium price is expected to enter a brand new bull market in 2026. A new setup is emerging. So lithium stocks have been dominating the leaderboard. I've been speaking a lot about Albemarle. Their shares are up 30%. They're the best performer in the S&P 500 this month. But broadening it out, we've got some local lithium stocks that are doing really well. In the ASX 200, we've got IGO, Independence Group, that's up 26%, making it the best performing stock. And we've also got the biggest pure play lithium company on the ASX. It's up 20% as well so far this month. So why are we talking about lithium now? Well, remember last time I spoke about lithium back in October, I spoke about it entering a bull market, meaning it's up 20%. Well, at the time, the lithium price was actually up in more of a bull market than that 20% gain. It was up 30% from its low. And since we last spoke, the lithium price has extended. It's now on steroids, and it's extended its rally. It's up 50% from its June low. Now, this basically reflects that the lithium bull market, a new one, can be born. And this means that companies' profits can substantially increase, obviously, because the lithium price is higher. But the bottom line is that institutions are probably going to be encouraging investors to buy in. And this could also usher in a lithium upgrade cycle, which also is why you might want to potentially consider getting ahead of an extended bull run in 2026. Basically, because now the thinking is the lithium deficit is expected to be brought forward to 2026 instead of what we were previously expecting it to be in a deficit in 2027. What is a deficit? Well, it basically means we've got tight, restricted supply and demand is rising, and that's exactly the case right now. We know Albemarle, they recently released their results. They basically came out saying global EV sales are rising more than expected. Global EV sales, electric vehicle sales, are up 30% year on year, and lithium-ion battery demand for storage systems is also fueling demand as well, and that is up 105% year on year. We've also got SQM, the world's second biggest lithium company, also saying similar scenarios as well. They also see higher sales continuing into 2026. So the question is, what do you do right now when you've got the two lithium giants, Albemarle and SQM, saying we see high lithium prices ahead? Do you buy, hold or sell a lithium stock that you like? Maybe I would be pointing towards buying. The fact is that Bloomberg basically suggests that 2026 will be a favourable year ahead. That's shifting in your compass. Bloomberg Intelligence is suggesting that. So I would be keeping my eye on lithium stocks with a long-term view. And of course, I spoke about a broad pullback. Remember, if we do experience a broad pullback, you might be expecting lithium stocks to see some profit taking, but what we're basically saying here, or what I'm basically saying, is a bull market scenario might be intact over the long term for lithium, so you should be potentially looking for pullbacks as an opportunity to get exposure to a long-term position. With that view in mind, let's bring in our stocks to watch for the day. The first stock is Pilbara. So Pilbara Minerals shares their extending their rally. Yesterday, they rose 4%. They're now up 270% from their June low. So there's a couple things that are happening that are obviously pulling Pilbara higher. One of those is options. Options are actually suggesting Pilbara Minerals will head to higher ground. And the second reason Pilbara Minerals is moving higher is obviously the fundamentals are there supporting lithium prices higher in 2026. However, analysts are mixed. Pilbara was kind of getting a few downgrades yesterday. Macquarie yesterday gave Pilbara a neutral rating. Morningstar actually downgraded the stock, saying it's run up too fast, too quick. It's probably a sell. So do keep your eye on Pilbara. It's a very volatile stock, but I would be expecting potentially higher levels for next year. Consensus among analysts is that it's a hold. The second stock to add to your watch list is, of course, Google parent Alphabet. Alphabet shares took off like a light overnight. They were the biggest gainer in the US market, and they were just one of the 23 stocks in the NASDAQ that rallied, and they were the only stock in the Magnificent Seven that rallied. So well done to you if you are holding Google with their shares rising 3% overnight. They're now up 100% from that market bottom that we hit this year. But what is really exciting investors is that Berkshire Hathaway recently disclosed that they bought into Google. This was their first ever holding in the company, and they've now got a $4.3 billion US stake in the company. So this is pretty pleasing. One of the pin-up investors has now got a massive cash pile, so he's quite cautious on the markets, but he's gone out on a limb and he's taken, I guess, a very large position in Google at a time when he's selling out of Apple. That's something for you to consider. Alphabet, their shares are also perhaps looking cheaper, I guess you could say, from a valuation perspective compared to their other AI peers. So when we talk about price to earnings, it's the amount of the money that you actually pay for the stock versus the amount of company earnings are generated. So that's why we say it's looking cheaper compared to other AI peers. And what is that? Well, Alphabet is trading at a price to earnings multiple of 26.9 times next year's earnings. That means it's looking pretty cheap compared to its peers that are trading about 30 or 40 times earnings, such as Microsoft, Nvidia and Broadcom. Luckin Coffee is the last stock to add to your watch list. So why we're talking about this one today, I'm not sure if you've been to China recently, but the chances are that you may be buying a Luckin Coffee if you are looking for Starbucks, because there's no Starbucks there. From what I can see, Luckin Coffee is their coffee chain. And Luckin shares took off nicely yesterday, jumping 6%, obviously delivering better than expected numbers to the market. And what were their numbers? Well, their profits rose more than expected. Net revenue did as well. Net revenue up 50% year on year, and they opened 3,000 new stores. They've got now 29,200 stores, and they are growing faster than Starbucks. So this is something that's really exciting. Investors are showing that their margins are increasing at a time when Starbucks is a little bit on the nose. And the stock is also doing really well. It's up 57% year to date. So perhaps that's a stock to add to your watch list.